Deepak Sharma. The topic which I have selected for my presentation is Basics of Partnership Firm Taxation. So in this presentation, I am going to cover the basic things that we need to understand when we are handling the taxation of a partnership firm. So the first thing that I am going to explain you is about the tax rate. So what is the tax rate applicable to a partnership firm? The net profit of a partnership firm is taxable at the base rate of 30%. Apart from this, if the net profit of a partnership firm exceeds rupees 1 crore, then an additional surcharge of 12% is applicable to partnership firm. And apart from these two taxes, the health and education cess at the rate 4% is also applicable to partnership firm. Now we are going to understand about two permissible deductions that is allowed to be deducted from the net profit of the partnership firm. These two deductions are interest on capital and remuneration to partners. Interest on capital is the amount of interest that the partnership firm pays to its partners on the amount of capital contributed by the partners. But there are some limitations and conditions to claim this deduction. The first condition for allowing interest on capital is that the partnership deed must contain the provisions relating to interest on capital, and the second condition is that the maximum rate of interest on capital is 12%. Second most important deduction that is allowed to be deducted from the net profit of the partnership firm is remuneration to partners. But there is a limit prescribed under Section 40B of the Income Tax Act that how much remuneration we can deduct from the net profit of the partnership firm. So the limit is contained in two parts. On first 3 lakh of book profit, or in case of loss, the maximum remuneration that can be allowed is rupees 1,50,000 or 90% of book profit, whichever is higher. On the balance of book profit, the maximum remuneration that can be allowed is 60% of book profit. So here I have mentioned a term that is book profit. So we have to understand first what is a book profit, because the limitation of remuneration is calculated on the amount of book profit. So what is a book profit? So for arriving at the amount of book profit, we need to calculate the net profit of the partnership firm as by following the accounting principles. After having the net profit, we have to make adjustments from section 28 to section 44 DB, and then we have to add back interest on capital and remuneration to partners. Whatever amount we will get, that amount is called book profit. But apart from this, some more adjustment needs to be we need to understand that while calculating the amount of book profit, we should not add other incomes of the partnership firm. That a partnership firm may have income from capital gain, income from house property, or income from other sources. These incomes are not added in the book profit. Apart from this, the brought forward losses of the previous years are also not allowed to be deducted, but we can deduct the unabsorbed depreciation of the previous year. So this is all about book profit. Now we are going to understand what are the income tax return form that a partnership firm may take up for filing its income tax return. So a partnership firm may opt for either for ITR 4, that is Sugam, or they can go for ITR 5. If the partnership firm is filing its return under presumptive taxation scheme, they can go for ITR 4. But if the partnership firm is maintaining proper books of account, they can go for ITR 5. This is all about the basics of partnership firm. I think it will help you to understand, or it will help you to have the basics of partnership firm taxation while handling the taxation of a partnership firm. Thank you.